neutrality here at the beginning of class. And so we spoke at the end of last class about the basic definition of risk neutrality in the context of a binomial tree model.
Oh, who erased the board?
Yeah, no, they did a good job though. So we had two different returns. There was an upper return and there's a lesser return given D. And there's a binomial process that would either go from one to the other. And we know the risk-free rate is going to be somewhere in between, right? Risk-free rate is going to be somewhere between the higher and lower returns. And there's a special probability called the risk-neutral probability, which we call P star. And it has a corresponding probability of 1 minus P star. And given these two probabilities, if you weight the outcomes using these probabilities, the average return is the risk-free return.
Hey, Brian. Brian, you put that thing down?
Oh, sure. So P star times the upper return plus 1 minus P star times the lesser return provides an average return of the risk-free rate. And this risk-neutral probability, it's not unique, by the way. Just in case you're going to go read a little bit more about risk-neutral probabilities. It's only unique in certain special contexts. And if you have like a trinomial tree model, for example, it's going to be an entire line worth of weights that you can apply to the different outcomes to get, on average, the risk-free rate. So it's not unique, but there's some probability that you can weight these returns that will provide you, on average, the risk-free rate. Yeah.
Risk neutral and risk free are the same thing?
They're not. I may be mixing them up unintentionally, by the way, so keep me honest, and if you're confused about anything, definitely let me know. Risk-free just says, what return can I get for my money with absolute certainty? Risk neutral is a much more difficult idea. So the risk neutral probability averages out the two different returns to give you the risk-free rate. Okay. And so what we talked about last class was that the risk neutral investor is someone who is fine getting an average that's equal to the risk-free rate. Where not everyone's going to be comfortable getting an average that's equal to the risk-free rate. Many would rather have a guaranteed risk-free rate. If you can get, the analogy we gave last week was, if you can get $1 every year, that's absolutely guaranteed. Most people are going to say, give me that. A risk-neutral investor is someone who doesn't mind getting an average of $1 over the course of the year. So he flips a coin and he gets 0 one year. You know, if he gets heads, he gets 0. If he gets tails, he gets $2. So he gets 0 one year, he gets $2 the next year. They average out to an average of $1 per year. Risk neutral says, I'm fine with that. I don't care if I get an average equal to the risk-free rate, right? So this goes back to something that we haven't spoken about, and I wasn't sure if it would end up that we needed to talk about utility, but I think it'd be best if we actually talk briefly about utility. Utility is a fictitious quantity, and you can describe it as a numerical value applied to satisfaction. And there's even a fictitious quantity, a fictitious unit called a util, UTIL. So utils are this unit that we apply to this level of satisfaction that we're getting from, consuming some good or service. So, root canal, the utils are probably not that high, but something like a movie or whatever, the utils are pretty high. So, some way to quantify the amount of satisfaction that we're getting out of a given good or service. And every individual theoretically has some utility curve for every product, right? So if you're consuming 0 of them, we'll assume you're getting 0 utils out of the good or service. So the amount consumed is horizontal, and then the amount of satisfaction we're getting is going to be on the vertical axis. So generally speaking, the amount that you consume is going to increase the amount of satisfaction that you're receiving. So you're eating pizza, you're happy, you're happy, you're happy. But at some point, the more pizza that you eat, the less it increases your happiness. And it can actually go negative, where if you eat too much pizza, then you're puking or whatever, right? So this is the utility curve for a lot of different goods and services that we consume. It's called a diminishing marginal utility.
Is there some kind of law of diminishing utility, law of diminishing return?
Yep, so I'd have to look that up to see if it's the exact same thing. But
Probably not, so.
I think it's close. If it's not the same, I think it's closely related. Yeah. But diminishing marginal utility says that for most goods and services, the amount of utility that you get for that one extra unit that you consume increases your utility by a pretty good amount, but it diminishes over time, so that the amount of increased utility you get starts to decrease the more you consume, right? And this is for most people and for most products, right? And this includes money, right?
Does it?
Yeah. Believe it or not, right?
I haven't seen one yet.
Right. No, but if you think about it, you're young, you get your first job, and you make, $300, your first paycheck. You're really excited, right? And then, you get a better job, you're making more money to where now, you're making $1,500, and you're kind of like, okay, cool, whatever, So, it definitely holds for money as well for most people. So, if this is some investment return, you make, say, $50,000, and you're really, really excited about it. That increased your utility to a large extent. But then from 50 to, say 75, 50, 75, you're still, very, very excited, but at a rate that's not increasing as fast. And then 75 to 100. And again, you're still very excited, but again, at a rate that's slower than your first 50 or your first 25,000 or your first 75,000. So this is typical of most investors, and this is what's called a risk-averse investment. Before, I could make 50,000 or 100,000, or I could average the two and get 75. And I don't really care if I get 50,000 one year and 100,000 the next year and 50,000 the next year and 100,000, and it averages out to 75. I don't really care as long as I get an average of 75, right? So that's a risk of neutral investors, that he's okay getting 75,000 on average, right? But for most investors, they're what are called risk averse. And they say, you know what? I know that if I make these repeated investments over and over again, I'm going to average out to 75,000. But I hate seeing these wild swings in the returns of 50,000 one year, 100,000 the next year. So I'd much rather have this amount here at a fixed, in a fixed way where every time I make this investment, I wish I could just get the same amount every single time, right? So a risk neutral investor says, I'm willing to give up some return for a little bit of certainty about my returns. And so maybe this point right here is at about, we'll say, 68,000. So that's what a risk-averse investor is someone who, even though on average, he would be making 75,000 if he made this investment repeatedly, got 50,000 the first time, 100,000 the next time, and so on. He doesn't care, and he would much rather have 68,000 that's guaranteed, right? And so this is what's called a certainty equivalent. And the more risk you are, the more risk averse you are, the lower your certainty equivalent. You say, I'll go all the way down to 52,000, just as long as I can get it guaranteed, right? So the more risk averse you are, the more convex this curve is going to be. Probably, but yeah. So you make an investment, you could get 50,000 the one time, 100,000 the next time, and you want to figure out what's my level of certainty that I'm willing to trade in order to get a certain level of outcome instead of an average of 75. Yeah. So, all right, that is what's called a risk-averse investor. They're willing to trade some return in favor of certainty. A risk-loving investor is someone where they actually have a concave up utility curve. And this is someone who gets excited by risk, where some years his investments are going to return 50,000, other years they're going to return 100,000. And from a risk-neutral perspective, a risk-neutral investor would be fine making 75,000 on average. And this person's certainty equivalent is actually higher, where he's making 75,000 on average, but it feels as if he's making, 84 or whatever. He's getting, utility, he's getting satisfaction out of the risk that's sort of inherent in this particular investment. It could be 50,000, could be 100,000, and that risk actually gives him more excitement and more utility than the normal investor. So this is what's called risk-seeking behavior. He's only making 75,000 on average, but to him, he feels like he's making it, right? So his certainty equivalent, it feels like he's making 84,000, even though he's making 84. So this is what's called risk-seeking behavior. And this is surprisingly common. Lottery addicts and gambling addicts all have this sort of risk-seeking behavior. And there's a lot of people, a lot of traders, people who are moving in and out of positions all the time, and not really investing in companies. They're more just buying and selling stocks based on whatever system they've cooked up or system that they follow. They might have a risk-seeking utility curve as well. And so the border case is where the utility curve is in fact linear. And to this person, he's getting $50,000 one time and $100,000 the next time. And he knows he's not going to make, 75,000 guaranteed. But to him, it just kind of feels that way, right? Where he says, okay, if I just keep making the same investment, then, you know, I'm cool. I got basically an average of 75,000 each time I make the investment, right? So that's risk neutral, where you don't care that technically your money is fluctuating. All you care about is that on average you're making some given amount, and your risk, your certainty equivalent is in fact the average return that you're actually making, right? So that's risk neutral behavior.
It sounds like it's quantifying like the emotional response to whatever it is you're consuming.
Yeah, exactly. And so that's pretty much exactly where those labels are coming from. But it's great because you can actually quantify it now, right? Where if you've got a gap here of, in this case, it's a gap of $7,000. That $7,000 divided by the $75,000 says that you have a 10%, additional expectation that you're able to quantify just how risk averse you are. You're saying I want 10% extra because I don't like the uncertainty of not knowing if I'm going to get 50 or 100. And so that gap essentially is a way of quantifying just how risk averse you are. Yeah, sort of quantifying that attitude. Exactly. So where was I? This is risk neutral. So what's interesting about these risk preferences is that in a good chunk of finance, you can actually price things as if risk preferences don't even matter. And it's called risk neutral pricing. So the best example of this is pricing options. Have you guys heard of the Black-Scholes equation? Okay, Black-Scholes equation is, so an option is a contract to buy a stock at a certain date in the future, only if you want to. And it's at a fixed price. So you can say, okay, this company is trading at around $100 a share. 6 months in the future, I think it's going to be at 120. So you can buy an option that says, I want to be able to buy this stock at 100, even if it goes all the way up to 120. So this option trades just like any other investment would, and it has a price, and you can buy or sell it at different prices, and you want to figure out what's the optimal price to buy this option for. And in option pricing, basically what you do is you cook up a portfolio with the option and the underlying stock to where the option and the stock essentially are in these portfolios that mimic each other. And by combining these portfolios in just the right way, you can essentially get all of the fluctuations of the stock and the option to essentially cancel each other out to where you bake in a certain return, and that return is guaranteed. So if a return is guaranteed, that means that it has to equal the risk-free rate, because if it's guaranteed, then
It's risk-free.
then it's risk-free. So you take this portfolio that you've constructed and you can discount it back to the present value at the risk-free rate, and that tells you the exact price of the option at the present time. So what's interesting about this is that in this calculation, the growth rate of the stock actually doesn't factor into it. And you can derive the price of the option just based on the volatility of the underlying stock. And the growth of the stock is involved in cooking up the portfolio that you use to mimic the option, right? So you actually get to incorporate the growth rate of the stock, but it fades into the background when you're mimicking the option. And it actually drops out of the equation at some point. And so the underlying growth rate of the stock, that's actually where risk preferences are taken into consideration. So you have these risk preferences completely drop out of the picture, and you're now valuing the option as if everybody didn't care about risk, right? And so risk neutral valuations are a setting in which pretty much everyone's hurdle rate is the risk-free rate, right? And so the reason I'm going on so long about this is because in this particular pricing theory that we're going to develop in this reading, it's from a risk-neutral perspective. And so that's sort of the underlying philosophy, is that in certain contexts, the risk preferences of investors actually drop out of the equation entirely. And when that happens, you get to work pretty much with pure algebra. You don't have to incorporate any risk preferences or any utility curves or anything like that. And so what we're doing in this particular reading is very, very algebraic, and you don't have any utility curves or anything like that. And so even though it's a little bit, even though it seems a little bit unrealistic, like it seems like risk preferences should matter, it turns out that no, in certain models you actually don't need them at all, and you actually just get to work with the cash flows of the different assets and develop your pricing theory around that. So, I know that was a lot. All right. So, in Casey Boer's elementary asset pricing theory, we're going to look at his simplest model, which is just two time periods. So t equal to 0 is today. And t equal to 1 is tomorrow, whatever that means, right? Tomorrow could be tomorrow, or next month, or next year. And we have a collection of states of nature. So S, capital S, is the states of nature. In time 1. And generally speaking, the states of nature is going to be huge, right? Where you know, if you trade oil, for example, one state of nature would be everything's running smoothly. Another state of nature says that a pipeline in Nigeria has been bombed. Another says that there's been progress on the Keystone XL pipeline. So you've got all kinds of different states of nature that can occur. So if you're trying to do something in full generality, then S is this extremely numerous set that describes all the different things that could happen. But in this particular model, we are assuming that it's finite. And then, of course, in more sophisticated models, you can have a whole continuum of different states, right? And a lot of models, you can actually still use this, but with just a few possible outcomes. So the binomial tree model is a good example where you have essentially two different states of nature. You have an upstate and a downstate, right? So it doesn't have to be some gigantic set, but if you wanted to apply it to something like, you know, oil futures or whatever, your state space is going to be ginormous.
What was that word? I'm sorry. Assumed to be
Finite.
finite?
Yeah, finite. All right. Vertical bars enclosing S, this is the number of states. So assets are denoted by I, so PI is the price of the ith asset. And then we can also label the time that we're talking about. So PTI is the price of the ith asset at time t. And these are all functions of the state. So at time 1, so that, time in the future, the ith asset will have a price at time 1 that depends on the state s, lowercase s. So this is the price of the ith asset at time 1 in state S. So that's what I mean about this notation. It's very, very dense. There's a lot of information there. But any questions on what any of that stuff represents?
There's usually going to be multiple S's, right?
Yeah.
How are they differentiated? How do you know which S? we're talking
Typically
about?
just 1, 2, 3, 4, 5.
As a subscript?
No, as like a function where you say, I'm inputting state 2. What's the
Oh.
price at state 2? So it's like a function.
How do you read it?
Price of the asset at time 1, assuming state S.
In state one.
Yeah, so in state 1 or in state 2, whatever the state may be. Yeah, that's a good one, in state, whatever. So these prices can be positive or negative. So it gets kind of confusing. So an asset is going to have an owner. And for an owner, a positive price means money came to that owner. They received money. And of course, a negative price means that they paid money.
When we talk about assets, are we talking about actual things, like a house, a car, or are we talking about assets in terms of like stuff? I don't know,
Things.
I don't know, what are the things that are not things?
Right, yeah,
Things that are bought and sold that don't exist.
Yeah, both.
Both,
Yeah,
okay,
so
so it's generalizable to,
Yeah, anything that you can put a price on and buy and sell. So,
Okay.
yeah. Friends of mine,
Options, maybe?
yeah, options. Friends of mine tried to sell their soul on eBay one time.
yeah.
So,
Are they getting buyers?
I think they got stopped, actually, I think they stopped them, yeah, but, I'm not sure if that's a thing or not. But
Can your knowledge be assets?
exactly, so that would be a really good intangible.
Copyrights?
Yeah, yeah, so, let's take a look at what's called a cash flow vector. So each asset has a cash flow vector. And you split this vector into the current time and the future time. So the current time is going to be denoted by negative P naught I without any S. Okay, so you just pay a certain amount for asset. And then the next items in this vector are going to be described with P1 I of state 1. Right? So this is asset I at time 1 in state 1. And this is the amount that you either receive or give up at that time. Right? Because prices can be positive. Same thing here. This would be P1I in state 2. P1I in state 3. And so in this particular vector, it indicates that there's 4 states of nature.
And we're only doing P naught and P1. There could be other times, like
Exactly.
in a more complicated model.
Yeah. All right, so that's your typical cash flow vector. And yeah, so they all have that same structure of the first entry is the amount that you're buying or selling today. And the next entries are, they describe every possible state of nature that you can have in the future.
So they're not all negative in the first one. Do they have to be
Correct.
negative the first one?
No,
If I'm
these,
selling it, it's positive.
exactly. Yeah, these could have any sign that you want. And we'll talk a little bit more about that next week.
Negative means you're buying, correct?
Yeah, negative means a cash outflow, and
Yeah.
positive means a cash inflow. Exactly.
When you start out by buying, it's
Usually, yeah. So, a good example would be, the price of gas fluctuates each day, right? So you could buy a gallon of gas. You could buy a gallon of gas for $3.25 today. And so this asset, something that you're buying, and so you have to pay money to acquire that asset. And maybe tomorrow's going to be a good day for gas, and you can sell it back at $3.30 for that gallon. Or in another state of nature, it could still be $3.30, right? You don't need different prices for each state of nature. It could be that you have the same price in 2 different states of nature. $3.35, $3.35, or $3.40.
And why distinguish them as different states?
Because there's going to be different assets that could all take on different prices in all the different states. So basically, the states exist independent of the assets, right? If an asteroid hits, if an asteroid hits the Earth, the assets are not going to affect that, right? The asteroid affects the assets, but the assets don't affect the asteroid, right? So the states of nature exist, and the assets respond to the different states of nature.
So how many states of nature are there? That means that there is a set number.
For this model. Yeah.
Oh, okay.
Yeah, for this model, there's some finite list of states of nature. And it's obviously something that if you wanted to be more realistic with this, you.
So more simply put, are you saying dependent variable, independent variable?
Exactly.
Yeah, the S's,
Interesting, but
Assets don't affect asteroids.
so
well, the S's are the asteroids. So,
I would say that.
Oh, asteroids are assets?
So the state of nature is the dependent variable, the dependent is the asset price.
that's right, yeah. Sorry, I thought you said asteroids. Yeah, the assets are affected by the states of nature,
Right. Such as asteroids,
such as asteroids.
but not vice versa. Not the
Yeah,
other
but
way.
the assets don't affect the asteroids. The
Right.
asteroids can happen, right? So yeah, so that's the idea is that there's all these states of nature. Some of them are going to affect gas prices, others are not going to affect gas prices, but some of them are going to affect other assets even if it didn't affect gas prices. So you have other assets and they're all responding to the same set of states of nature.
Is this a predictive analysis, or is this post, is this after an event analysis? For instance, do you come up with these vectors before or after instances have occurred?
Yeah, let me think.
Even the rumors will affect it.
Right, I can see it being a living type of entity where you adjusted it as things come to pass.
Yeah, that's a great question.
It's probably adaptive as things change, I would guess.
Yeah, definitely. This is a static model and there are dynamic models, definitely, yeah. So.
I see. Okay.
Yeah, yeah. So, but I'm glad you asked. But yeah, there are definitely dynamic models, and that's actually sort of one of the directions that Casey Border takes in his later readings is actually making it into a dynamic model. But your question about whether you do this before or adapt to it, in this particular model, I think we'll answer that question in a later week where we talk about risk neutral measures. Yeah. All right, good. So you'll notice all the signs, right? So we paid money here, and then if we turned around and sold it the next day, we'd be making that much money. So sold it because we paid money, and then here we're getting money. So you can flip this around though, and you can actually gain money on time step 0, and pay money on the later time step, right? So an example would be a bank. A bank accepts a deposit of $10, and it has the following cash flow vector. So the bank, this is from the bank's perspective. You always kind of have to keep the perspective in mind. So it gains $10 on time step 0, and then time step 1, it pays 5 cents in interest, or 5 cents in interest, or 9 cents in interest. So that's the cash flow vector just for one asset that the bank sees. It accepts the $10, and then the next day the customer comes out and withdraws interest, and the amount of interest they get depends on the state of nature that they were in when the customer withdrew it. Okay. What would the customer perspective look like?
Signs it like 10.
Yep, yep, all the signs flip. He paid $10 on time 0, and then the next day when he came back, these would all be positive.
And those 5 states of nature are the same 5 from the previous example. I mean, would be in the way we're doing this model.
Right, yeah, so if this were the same world, and these were the same states of nature, then yeah, the S's there would exactly match the S's here. Yep.
I would say that the right side, we have a control situation, so the bank already controls the interest rate payments, right? And on the left side, the state of nature is kind of uncontrolled because we don't know what's going to happen to the price of oil. But in this case, we at least know because the bank tells us that the interest payment is going to be 3% a year or so on and so on. We can,
But maybe it's tied to the Fed rate, and then we don't know.
Yeah,
the decision.
It's all kind of contingent on different things, but yeah, we're actually going to use a similar example later on where we'll talk about something related to that I think will sort of, I mean, you guys can all see what's going on, so it's not going to clarify anything or enlighten anything, but just give us sort of a more tangible something to chew on related to that comment. So let's take a look at a risk-free asset. A risk-free asset is one that returns the same amount in all states of nature at time one. So this risk-free asset takes a little bit of getting used to, right? Because here's an example of a risk-free asset. You go and deposit $10,000 into a bank, and they hold it in like a high security vault. So you go deposit $10,000, and they charge you $100 to hold your money in a high security situation where you know it's not going to be stolen or destroyed, like a safety deposit box. And so you know that in all states of nature in the future, you could go to your safety deposit box and get your money. The only problem is the bank charged you $100. So this is the sense in which it's risk-free, is that you get a guaranteed amount of money in all states of nature. Risk-free doesn't mean you don't lose money, it just means the amount of money that you get is guaranteed, right?
would the second example be risk-free if the bank guarantees you a rate for a certain period of time? The bank.
This one here? No, this wouldn't be considered risk-free because you don't know which of those you're going to get.
Oh, okay.
Yeah.
But if it was a guaranteed rate, so that then it didn't matter, then it would be.
So you're saying if we didn't have this vector, but we had some different vector where, yeah, as long as it's all the same state, all the same rate in each state of nature, then that would be considered risk-free. Yes.
We're going to mix it with our binomial pyramids from before.
No, so those were mainly a tool for describing risk neutrality and also for sort of picturing states of nature. But those were more of a little detour.
Okay.
Oh, okay.
Yeah. All right, good. So we're going to take a look at the risk-free rate of return. So risk-free rate just says what percentage do you gain or lose on money invested in a risk-free asset. So you've got 1 plus the risk-free rate times the price at time 0 of asset. No, sorry. times the price. And that gives you the price at time 1. And so you just solve this equation for R. And you get R equal to P1 over P naught minus 1. And so in this example here, in that previous example, we have the amount that we get at time 1 is 9,900. The amount we started with was 10,000. And so our risk-free rate then is minus 0.01. And we always assume that R is greater than negative 1. So I always assume that there's some amount of money that we actually get back. But it could be that this is a really expensive safety deposit box. Maybe we actually have to pay 99% of our money to this thing. But we always assume R is at least larger than negative 1, so that we always have some positive amount of money left, assuming that we started with a positive amount of money. So another example might be, a more typical example really, is if you've got a guaranteed government bond, like the US, for example. They've never missed a payment, they've never been late on payment. So people treat these as risk-free assets, and so maybe at time 0, you spend 1,000 to get a government bond, and at time 1, in every state of nature, you get $50 more than what you started with.
There's only a risk-free rate if it's a risk-free asset, though. Or
That's
can we
correct.
figure out a risk-free rate from an asset? What's a non-risk-free asset? A variable asset? An asset, a regular asset?
Contingent claim, something that's contingent on the state of nature, yeah, so contingent claim. But we're actually going to cook up a risk-free rate out of an arbitrary set of assets. And this has to do with the discounting stuff that we started talking about. And so you can cook up your own risk-free rate, but it depends on the set of, so there are these things called error-to-grow prices, which we're going to talk about. And depending on which set of error-to-grow prices you use, you'll get a different risk-free rate from this risk-free asset that we're going to cook up. Unless you determine that the error-to-grow prices are unique, in which case you get a unique risk-free asset. So it's not that one of these is necessarily needed. What is really needed is, you're familiar with linear algebra?
No. Yes.
Yes, you are.
Okay.
Yes, you are, yes.
So basically you have these cash flow vectors, and each one represents an individual asset, right? Well, if you take sums of these assets, you're basically creating a new asset, right?
Mm-hmm.
So if you have error-to-grow prices that are unique, what that says is that every asset, you have a collection of assets in your economy that you can use to create any other asset in that economy using a unique linear sum of these other assets. And so in the case that the error-to-grow prices are unique, then there's going to be exactly one way to cook up a risk-free asset. And so that's, and it happens pretty often that you can look up unique character prices. And so, yeah, you can generally do something like this. And did that answer your question?
Sure, I think so. I think as we get further into it.
Okay, all right.
Yeah.
So for this one, we won't go through the calculation, but you can sort of eyeball it. We've got 1050 over 1,000 for a total of 1.05 minus 1. So the risk-free rate here would be 0.05. Okay. All right.
Sometimes it's just mind-boggling how inventive people have been to find ways to leverage numbers. It's really,
Yeah.
yeah, right? We
Yeah.
got some real specialized products, and wow.
Yeah, I agree. And so let's take a look at a portfolio. So a portfolio is simply a collection of weights that you're going to assign to each asset. And we list it in vector form. So X1 is the weight that you're applying to asset one. So if you have, $100,000 that you're investing, you can put $5,000 in asset one. And X2 says how much you're going to put in asset two. So you can put $10,000 in asset two. So these weights simply tell you the quantity of each asset that you're going to be buying.
Command.
Yeah. And different assets. So, this is the start of what we were talking about earlier when we were talking about taking combinations of assets, is that you have these individual assets, they're sort of, put together by a bank, or they're, physical object or what have you. And these things are essentially, you could call them God-given, where they just exist, right? But as you sort of combine these things together, what you're essentially doing is you're creating a whole new asset. And this new asset has its own cash flow vector. And that cash flow vector then can be listed, and it'll look the same as what we have here, but it's in fact a combination of other assets, right?
So each asset is basically a state, right? A state of nature.
So, let's take a look at an example where a bank accepts deposits and pays 2% interest. And it has a portfolio of investments. It can invest that money with the following cash flow vector. So the bank can make money at a rate of, it spends $1 to invest, and then at time one, that money is now worth $1.01, $1.04, $1.04, or $1.05. So this is what the bank's going to make. What does it pay to the customer? So we're still from the bank's perspective, but we want to, this is what the bank's doing with its own what's its relation to the customer?
Positive one.
Positive one, because it receives money from the customer.
And after that, it pays its 2% on top of that.
So it'd be minus 1.02 in each state of nature. So this goes back to your question about would that be considered risk-free? And in this case, yeah, this is an example where in every state of nature they're paying the same amount. So that's the technical definition. So that would be considered risk-free. So the bank can put these two together. So it can take a certain number of these vectors and a certain number of these vectors and put them together, and it creates a whole new asset. So if a customer deposits $1,000, then we have this picture here. The bank's going to take this and it's going to accept the money and invest the money on the same day, right? So here's the bank's investment vector. And here's the bank's customer vector. So we'll pay them 2 cents, 2 cents. And they're going to multiply by this vector here, 1,000 and 1,000. So this is a portfolio vector. So multiplying these out, you get 1,000 of these plus 1,000 of those. Questions on this three multiplication? You essentially just lay this vector down and you multiply, this entry by this column, this entry by this column, and you add those up. So 1,000 of these.
We have 1,000 of both in the portfolio because we're taking the whole 1,000 and investing it all.
That's right.
If we only took a part of it and invested it, one of those thousands would have to be
Less.
less.
That's less rich. That's
It
good.
would have to be the top one.
Yes, exactly.
Okay, good.
So spend 1,000 on investments because we gained 1,000 from our customer, right? We go all the way down, add these things up. So net, we haven't done, we haven't spent any of our money. It's pretty much to the bank's perspective. None of their money has actually changed hands, right? But during State of Nature 1, they've gained $10 from this investment, but they had to pay out $20 to the customer. So they lost $10 in this situation. They gained 40 from their investment, paid 20, so they gained 20. Gained 40, paid 20, so gained 20. Gained 50, paid 20, so gained 30. So that's a portfolio vector for this bank. If they have that option for investing, and they pay that amount to their customer.
Crazy question.
Yeah.
Why use a portfolio vector instead of a scalar vector?
Just because, so you're saying, why use?
No, the second matrix. Basically, the portfolio. Why use a portfolio vector or a matrix instead of a scalar?
Just because a portfolio is a collection of objects. So you've got this, a portfolio says, I've got this much of this asset, this much of this asset, and so you.
Oh, I see. At the end, you want to see that gain or loss. I'm sorry.
Yeah, so
So
you
the
basically,
question.
yeah, you sort of net it out. You say, okay, with this weighting in this asset, this weighting in this asset, we want to sort of get a net gain of loss. And so, yeah, we've got this vector that says, here's all my weights, and then using matrix operations, we can put that into a gain and loss vector.
Definitely, sorry about that.
That's okay.
In the second stage of nature, I mean, the first state of nature was negative. What happens in that case? In that case, it curves.
So in that case, the bank actually lost money. This was essentially saying that this had nothing to do with the bank's money, but at this point, they actually have to, pay, like, these, they're actually gaining money. They took someone else's money, and they're gaining money out of thin air, right? And this guy here, it's the opposite, where they took someone else's money, they didn't do anything with their own money, but now they have the consequence that they have to pay with their own money.
So what does the bank do at this point? They calculate the percentage, they would make money, the percentage they would lose money, or how would they take this further? Would this be an acceptable?
I don't think they do anything particular.
I think that's kind of common actually, where, some of these states of nature, they will have a loss, and you'll notice that.
And then just make up with other things.
So you
Yeah.
can't expect to be positive at all times.
Correct,
It's not
yeah,
happening.
yeah. And when you do have a positive at all times, you have some funny business going on there. It's all the arbitrage portfolio, so we'll talk about this next week.
Don't worry, Lord, they make it up money. All money.
So yeah, so this is a pretty good example that illustrates the portfolio idea. And I think we'll leave it there for this week. I do have several more examples that I wanted to cover, but we'll leave it there.